Welcome to the InterMarket Analysis video update. This is a video that I do every week where I look not only outside the S&P to other stock indexes and what's happening within the stock market, I also look to other markets outside of the stock market to see what's happening there, and sometimes we can get some clues as to what's happening in the S&P 500 based on what's happening in a different market. This is being prepared for Monday, July 3rd. Please pardon my voice. I'm dealing with a bit of a bug right now, so I'm finding it a little more difficult to talk than usual. The first thing that we look at is a thing called S&P 500 valuation. Are we expensive? Are we cheap? Are we just about right? We have two ways that we look at this. We look backwards based on history, and then we look forward based on projections, forecasts, and what analysts think will happen going forward from here. So the first chart that we look at, this is historical, where we look at the trailing 12 months PE ratio. This is price to earnings ratio. When we're at 20 or above, the market's considered to be expensive. When we're at 10 or below, the market is considered to be inexpensive or cheap. When we're between 11 and 19, the market is fairly valued in that range. We can see on the top, the black line is the S&P 500, and the red line is the 20 PE ratio, and we're quite a ways above that. So on a historical basis, we continue to be expensive. Then down below, there's a spread between the current price of the S&P and the red line, and anytime this is above zero, that means we're in expensive territory. We also can go back and look at different events and then see what were the valuations like during those times. Another thing that we look at is the Shiller PE ratio, developed by Robert Shiller. This uses more of an average of earnings over a period of time, and currently we're getting a reading of 31.07. Well, what does that mean? What we do is we look at the median and the mean up above, and it's between 16 and 17, so we're about double what the historical price for this indicator has been. But the market doesn't do that. They look forward. When you take projections and forecasts for the S&P 500, we're currently at a PE ratio of 19.2. That's under 20. Then we also look at the mid caps, where the current forward-looking PE ratio is 13.9, and for the small caps, we're at 13.5. Then another thing that we look at is growth versus value. Growth is where you buy low and sell high. Value is where you might hold on to something, maybe an older company that's been around a long time, not as exciting to talk about, but they may pay dividends, they may have stood the test of time, and when the market hits difficult times, you may get into some value stocks. Where when the market's really going up, then people like to be in growth stocks. So first we look at the peer growth index, where this is in an overall downtrend, even though it has been bouncing up lately. We also look at a peer value index, which is also in an overall downtrend. Now, this is where it gets interesting. We start to compare the two. Growth is outperforming value, or to say that another way, value is underperforming growth. Then I have a number of different ways of analyzing this. This is an index showing where growth is outperforming value. Another look at an index shows where value is underperforming growth. Then we look at some ETFs where growth is outperforming value, and another look at the ETF showing where value is underperforming growth. Then another chart shows some indexes also suggesting that growth is outperforming value. These indexes, ETFs, and different things that we look at are all calculated slightly different, and that's why I look at many different charts. We also look at the small caps. Now, for a lot of 2023, going back to the beginning of the year, the small cap index has been under a lot of pressure. It has been bouncing back lately. But while the index was going down, we've been seeing small cap growth really outperforming small cap value. It's been chopping more or less sideways recently, but this has added some strength into the market that we don't always see otherwise. The mid-cap index has also been under a lot of pressure since the beginning of February, also showing some recent improvement. But during that time, growth has really been in an uptrend when compared to value, and even when it was going down, we're seeing growth outperforming value, and this is really where a lot of the strength in the market is coming from, even though we don't really see that very plainly. We also look at the S&P growth versus value, and it's in an overall uptrend, but we are chopping more or less sideways. For the S&P to really kick into gear and go higher, we want to see this ratio also going higher. We also look at another ratio of growth to value, showing that growth is showing a lot of improvement, and inverse of that shows how value has been really underperforming. Some inflation gauges. On the top is a monthly chart of the CRB index. This is an index for commodities, and it's in an overall downtrend. And then we look at inflation areas of the CRB index and compare it with deflationary areas of the CRB index, and then come up with a ratio. When we're below this red line, that means we're more deflationary, and the red line is also declining. We also look at the CRB index, which is in an overall downtrend. Then we look at the Baltic Dry Index. What does it cost to ship products from one place to another? This is also in an overall downtrend. If this was going up, that means it would be more expensive to ship products. Some other markets that we keep an eye on. Aluminum is in a downtrend. Corn is in a downtrend. Wheat is in a downtrend, even though it bounced up later in the week. Fertilizer also continues to be in a downtrend. Oil is also in a downtrend, kind of camping out around the 70 level. Heating oil is also in a downtrend. Gas, chopping around a little bit, but still in an overall downtrend. Natural gas, even though it's bouncing back up, is still in a downtrend. Diesel, which continues to be in a downtrend. Lumber, which continues to be in a downtrend. Copper, really chopping around a little bit here. We're not quite at a death cross yet, but we're getting very, very close. Typically, when the economy is looking more positive going forward, copper will go up. When things aren't looking as good into the future, copper will go down. Now, in conjunction with that, we look at the copper to gold ratio, showing how copper has been doing a little bit better compared to gold, but gold has been under some pressure lately. Then we take a longer term look at that same chart. The black line is the copper to gold ratio. The red line is the 10-year yield. The green line is the 2-year yield, and there's a real wide spread between all three of these. Usually they tend to go in the same overall direction, and quite often they don't get all that far apart from each other, suggesting that there's some economic uncertainty. Gold in and of itself is still in an overall uptrend, even though it's been falling back. Silver also in an uptrend, but has been falling back and dancing back around its 200-day moving average. We look at gold on the top and then silver on the bottom and see that there's a very high correlation between the two, which is not surprising, but this just gives us a chance to qualify that using statistics. Then we look at the gold to silver ratio on top, and we have the dollar index on the bottom. A general observation here is when the dollar index is going up, gold outperforms silver. When the dollar index is going down, silver outperforms gold. Now they can both be going in uptrends. You can see when the dollar index was going down, this ratio was also going down, meaning that silver was outperforming. As we've seen a little bit of strength in the dollar, we've seen this ratio going back up a little bit, and we're starting to see the correlation not as strong as it has been. They're having a slight tendency to go in opposite directions, so we'll keep an eye on that. We keep an eye on the dollar index, which continues to be in an overall downtrend. We also compare that to the euro, which is outperforming the dollar right now. And then we look at the Japanese yen, which is actually in a downtrend compared to the dollar, where the euro's in an uptrend, and then down below is the dollar index. Here's an isolated chart where the Japanese yen has just recently generated a death cross compared to the US dollar. But the British pound is still hanging in there and is in an uptrend when compared to the US dollar. Some different indexes that we look at. The S&P 500 is outperforming the CRB, and then an inverse of that shows the CRB index is underperforming the S&P 500. The NASDAQ 100 is outperforming the S&P 500. Now they're both doing well, but the real strength lately has been coming from the NASDAQ 100. We keep an eye on the ratio between the equal weight S&P 500, where all stocks are treated the same, and the S&P 500 itself, which is a weighted index. We're seeing some improvement with the equal weight index, but it's still underperforming the S&P. In a good solid upward move, we want to see the red line above the S&P line. When we look at mega cap growth, the really big companies that have been doing well lately and compare it to the equal weight index, the mega caps are really outperforming. The S&P 100 is outperforming the rest of the S&P 500. The small caps are really struggling and are underperforming the S&P 500. In a good solid environment, we will see the small caps really participating in this upward move, and we're not seeing that right now. The NASDAQ is outperforming the S&P 500. And again, both of these indexes are doing well, but the NASDAQ is doing even better. The NASDAQ 100, which is doing good, is outperforming the NASDAQ, which is also doing good, but overall, it's the biggest 100 companies in the NASDAQ that are outperforming. Some other stocks that we look at. Here's the NYSE Advanced Decline line, showing some improvement. The S&P 500 is also showing some improvement. The mid caps have gone back above the moving average. We were a little bit flat with the small caps, but we are above the moving average. The 30 biggest software companies are in an overall uptrend. The mega caps, this is what you're hearing about most of the time these days, they continue to be in a pretty solid uptrend. The robotics and AI ETF is doing quite well. It's above most of the rainbow, kind of dealing with the 20-period moving average here. But when we compare it to the tech sector, it's actually underperforming. The Dow Jones Composite Average. This is where we take the Dow, the transports, and the utilities, combine them all together. They've been chopping more or less sideways in a range, but continue to be in an overall uptrend. Low volatility stocks, which held up better in 2022, are chopping more or less sideways in 2023. And the low volatility stocks are really underperforming the S&P 500 in 2023. FANG stocks really in a solid overall uptrend. ARK had a recent golden cross, and we also saw a golden cross on the weekly chart for ARK, and it's showing some improvement. Then we're looking at Dow theory, where we've been concerned about this for a while when we compare the Dow with the transports. Well, now it looks like the transports are really starting to show some improvement and could be breaking out. But on the bottom, I include utilities as part of traditional Dow theory. Even though they turned up a little bit lately, they are still underperforming, which could turn out to be positive for the S&P 500. Here's a new look at Dow theory where we have the S&P on top where it's been breaking out. Instead of the transports, which used to be railroad stocks, now we have tech represented by the NASDAQ. It's also been breaking out. There's a little bit of a negative divergence here where the S&P is breaking out above this previous high. We're right at the previous high for the NASDAQ. Not a real big deal, but we do want to keep an eye on that. The S&P 500 is outperforming shorter-term bonds represented by the 1 to 3 year Treasury bond ETF. We look at a broad market measure of stocks and compare it with further out bonds. Also, stocks are outperforming. The tech sector is outperforming 3 to 7 year bonds. And then we look at the S&P 500 and compare it with Europe, Australia, Asia, and the Far East. We're still above this moving average. Now, this is a monthly chart, so it takes a while for these things to change. Down on the bottom, we have a PPO, which is a momentum oscillator. It has been turning up. So the S&P 500 is outperforming other areas of the world. We also keep an eye on bonds. The total bond ETF has been chopping sideways, but is still in an uptrend. The World Bond Index also really chopping around, but continues to be in an uptrend. We're coming down to what had been support before, and we'll see if we were able to bounce up off of that. Stocks continue to outperform bonds on a monthly chart. Bonds continue to underperform stocks. High yield bonds, which means junk bonds, continue to be in an uptrend. Investment grade bonds, which are more higher quality but give folks a lower return, they're chopping sideways but also continue to be in an uptrend. Folks are favoring being in riskier bonds. They're outperforming more conservative bonds. If this ratio was going down, it would be reverse. Since people are willing to take on more risk, that usually means they have more confidence in the economy. We also keep an eye on the stock to bond correlation, where they're having a slight tendency to go in opposite directions. Then we look at the corporate bond index, which also has been chopping more or less sideways, but is still in an uptrend. We compare the S&P 500 to the 10-year Treasury yield, showing where the S&P is outperforming the rise in interest rates. Here's a look at the 10-year yield and the corresponding Fibonacci retracement levels. Here's another look at the 10-year yield, and we're wondering, are we seeing a shift? Going back to 1980, we've seen lower highs, lower lows, all the way down until about 2018 going into 2019, and then the whole COVID crash happened. Well, now as we're starting to go back up, are we going to get more into an environment where we see historically higher yields than what we've seen over the last 40 years or so? Here's a look at the 30-year yield, still above its 61.8% retracement level. Here's an ETF of bonds where we're just a little bit above the 200-day moving average. The RSI is turning up, it's still below 50, and the MACD is getting ready to cross over negative. Junk bonds continue to be in an overall uptrend. We compare junk bonds to government bonds. Junk bonds are outperforming. Then we look at a daily chart of yields, showing how we've been chopping more or less sideways with most of the maturities, but we did see a downtick in Friday's session. Then we look at a weekly chart where the UK now has the highest rates, followed by the US, that's green. And then the blue area is Germany. Japan is red, and they're purposely keeping rates low there. It's another story that I'm keeping an eye on, that if it breaks and starts to affect the U.S. stock market, you will be hearing lots about that. We do some studies on the 5-year yield, where it is in an overall uptrend. On a short-term basis, using the KST momentum oscillator, it's going up. Intermediate term, it's pretty much flat, and we're still in a downtrend when we look at the long-term KST. Then we also look at the 5-year yield, where it's coming back above the moving average. When we use the special K, which is a longer-term momentum oscillator, it's in an overall downtrend, and we're pretty much flat when we look at the KST, another momentum oscillator. Long-term bond ETF. Now this is based on price, where we continue to be in an overall downtrend. On a short-term basis, we are showing some improvement, but we haven't crossed over positive yet. We're still kind of declining in the intermediate term, and we're still positive in the longer term. Then we look at the price of bonds and compare it with the CRB index, showing that bonds are outperforming commodities. The MOVE index measures the volatility of bonds, just like the VIX measures volatility of stocks. They're kind of having a tendency to go in opposite directions right now, and the MOVE index hasn't been around all that long, and I don't have a lot of historical data to do some studies on this, so I'm just kind of watching this play out to see what will happen. Internationally, looking at the stock markets worldwide, China is starting to roll over. Emerging markets are starting to roll over. Europe is starting to roll over. Japan is looking a little more positive, and we're looking a little bit like we're rolling over in the U.S. market, but we'll have to see if we can show some improvement there. Then we look at different sectors. The materials sectors is underperforming the S&P. Communication, that's where a lot of the growth is coming from right now. That is really outperforming the S&P. Energy is underperforming the S&P. Financials are really underperforming the S&P. Industrials showing a little bit of improvement, but are still in a downtrend compared to the S&P. Staples also in a downtrend. Real estate in a downtrend. Tech, even though the lines aren't on here, it's really outperforming the S&P 500. Utilities are underperforming the S&P 500. And then we take a ratio of the S&P to utilities, where this is going up overall, and if you look down below at when this was going up and then what happened with the S&P, a lot of times this gives some really good support to the market. When we're starting to go down with this ratio, a lot of times that will mark a top in the S&P, and then we'll see a decline in overall prices. Then we look at healthcare, which is in a downtrend compared to the S&P. Here's another look at healthcare showing how it has been declining. Then we look at discretionary, which is showing a lot of improvement. This is another growth area, and we've seen a recent golden cross with this ratio. The semiconductors are still in an overall uptrend, and the tech sector is also in an overall uptrend. When you compare the tech sector to the S&P 500, tech is really outperforming. Then energy is underperforming the tech sector. We look at growth stocks and compare them to bonds, where the growth stocks are really outperforming bond prices. The tech sector is really outperforming the rise in interest rates, even though most of 2022 it was the exact opposite. And then we look at the 10-year yield and compare it with the tech sector, where yields are going down in relation to the tech sector. The staples sector is still hanging in there. It's kind of bouncing between its 50 and 200-day moving average, but it's still in an overall uptrend. When we look at discretionary, which is now finally starting to outperform the staples sector, this is very good for growth stocks. Then staples are now starting to underperform discretionary. Gold is still in an overall uptrend, but we're seeing some weakness when compared to the S&P 500. Also showing some weakness when we compare gold to the dollar. Then we look at the home builders, and they've been just going to the moon lately. This ETF has really been shooting up. The ratio between the home builders and the S&P 500 has turned down a little bit because the S&P is actually underperforming the home builders ETF, but their relationship is still quite strong to each other. Then we look at an intermarket analysis chart going back to the beginning of 2023. Stocks are in the lead, followed by gold, and then bonds, and then the dollar. And what's negative going back to the beginning of the year is oil. High leverage loans continue to break out and are in an overall uptrend. These are considered riskier loans. And as I always say, if we were getting ready to fall off a cliff with the economy, this ratio would not be going up the way it is. Then we look at a ratio between the small caps and the S&P. That's the red line where they're really underperforming. And the blue line is the S&P 500. In a good, healthy environment, we want to see the red line and the blue line going up together. The NYSE composite is going sideways but still in an uptrend. The Wilshire is also in an overall uptrend. All stocks continue to be in an uptrend. Emerging markets chopping sideways but still in an uptrend. Bitcoin actually got a bit of a bounce, got back up into the 30,000 range, still in an overall uptrend even though it's coming off of some recent weakness. Looking at some correlations, we compare the S&P to the dollar. They're pretty much neutral right now. When we're at minus 0.25 to plus 0.25, that is considered neutral territory. When we look at S&P to oil, just a little bit out of neutral territory and having a slight tendency to go in the same direction. The S&P to the 10-year yield, they're having a tendency to go in the same direction. Then we also look at the S&P to the 2-year yield, also tending to go in the same direction. The tech sector to the 10-year yield, also more of a tendency to go in the same overall direction. Then some long-term secular and cyclical trend studies. We look at the NYSE on a monthly chart, and we are showing some improvement as we're coming back above the moving average, and the Kopit curve is starting to turn back up. So this is looking more positive on a broader measure. We also look at the NYSE and then look at the record high percent index. This is turning back up and is also showing a lot of improvement. Then we look at the S&P with the PPO, where the S&P is above the moving average on top and the PPO is rising on the bottom. This is longer term positive for the S&P. Then we compare the S&P to the CRB index, where the S&P is outperforming commodities. And then we look at the S&P with a global index on a monthly chart, where we're above the moving average above, but the KST continues to be negative below. So the last thing that I do in this video is I go through what's positive and what's negative. My definition of positive is when a 50-period simple moving average is above a 200-period simple moving average. Right now, that includes the biggest software companies, the euro and the British pound when compared to the dollar. Copper, even though it's chopping around, is still in an uptrend. Gold and silver are in uptrends, even though we've been seeing some weakness. The mega caps, that's what you're hearing about most of the time. The S&P low volatility ETF is still in an uptrend. The Dow Jones Composite Average, even though it's chopping sideways, is still in an uptrend. The FANG Index as well as ARK, and it took a long time to get ARK on this list. The different bonds that we look at, whether they're government bonds, junk bonds, investment grade bonds, world bonds, corporate bonds, all of them are in overall uptrends. The staples continue to be in an uptrend. The tech sector and semiconductors are also doing well. High leverage loans, the Dow and mid caps are also in uptrends. The NASDAQ and NASDAQ 100, the NYSE composite as well as the Wilshire, all stocks, and then emerging markets as well as Bitcoin. Then we look at what is negative right now. This is when the 50-period moving average is below the 200-period moving average. The growth indexes and ETFs, they are in downtrends, as are the value indexes, but when we compare them with each other, growth is outperforming value. The CRB index, the US dollar index, is also in an overall downtrend. The Japanese yen is in a downtrend when compared to the US dollar. The micro caps and small caps, and we're almost getting ready to see a potential golden cross with the small caps. So thank you. I hope you found this helpful. Please feel free to check out the other videos that I post. My hope is that you get some value out of this, and I will talk to you in the next video.